So this is a case study that's based on our own proprietary models, which you have access to on our site. If you go to app.valor.com, maybe if you want to put the link up, app.valor.com, you can go to one of our many tax calculators, including this one that helps you understand the potential benefit of QSBS stacking. So the study that we looked at here is a startup founder, although that's not super relevant. This is a person with a large amount of shares in a company, lives in New York City. The shares are QSBS eligible. And we assume here that prior to the sale, in fact, a few years prior, this founder gifts her shares to 3 separate trusts, non-grantor trusts specifically, one for each child, as well as one CRUT, a charitable remainder trust, for herself. So 4 separate trusts. So what does she get? You always get, and let's assume that the shares sell for 50 million. So she owns 1/5 of the shares. The CRUT owns 1/5 of the shares, and each of the 3 trusts owns 1/5 of the shares. She always is going to get her own $10 million exemption, whether she does any planning or not, right? So she's going to sell 10 million in New York City, totally tax-free. She's going to avoid probably about 36% tax on those shares. With the other trusts, if she didn't do any planning with the remaining 40 million, she'd owe tax on that amount, right? It's above the 10 million. She's selling 50 million total. So on the remaining 40, she would owe probably about 35, 36% in New York City, which would add up to something like $15 million of tax. If instead she parcels it out to all of these trusts, each trust gets its own $10 million exemption. And as a result, all $50 million, at least in theory, could be completely free of federal and state tax. So instead of paying probably about 15 million of taxes on the $50 million gain and keeping 35 million and then reinvesting it, and we assume you reinvest at an 8% annual rate, instead of keeping 35 and reinvesting it and having it grow, as you can see here, to about 47 after 5 years, instead she gets to take 50 million and not pay any tax and reinvest that full 50 million. Over 5 years, that grows to maybe something like 67. Minus, that 67 already has taken out of it that little bit of charitable gift from the charitable remainder trust. A couple of important things to note here. First of all, that's a lot more money for this founder and her family, right? An extra $20 million after taxes just 5 years later. Importantly, 30 million plus growth of that money is with trusts for her children, right? She's not getting access to that money directly. She's given it away. So if you or a client who's doing this really values holding on to the value of these shares, then the non-grantor trust strategy might not be a fit. Maybe it's just the 10 million for themselves plus a CRUT where they get the benefits back. In fact, we're working with a client literally right now to finish up a QSBS stacking CRUT. He's going to reap about 45 million of gains from his sale. And he ultimately decided he was not interested in giving the shares to a non-grantor trust for his kids. He wanted to keep control of all the money. That's fine. So he's getting a $10 million exemption himself and an extra 10 million via a CRUT. This founder is very happy to give 10 million each to the 3 kids. There's a lot of nuance to how that money can be invested and spent. It doesn't have to go to the kids immediately. That's a big benefit of using a trust here. Ultimately, it's going to those trusts. Peter, just in 30 seconds, do you want to talk about how you can direct and use that money in the non-grantor trusts?
Yeah, so the non-grantor trusts, you're not going to be a beneficiary. Typically, the way these are set up, they're usually for the benefit of loved ones like children. And so you can use the money can be invested in things that you want to invest in. There's no real investment restrictions on a non-grantor trust. And so if you want to invest the money in index funds, you can do that. If you want to invest the money in real estate, you can do that. If you want to invest the money in crypto or whatever, you can do that. What you can't do, unless you pay for it, is you can't just use the money for yourself. So you can't just buy yourself a house and live in the house unless you pay rent, in which case that's fine as long as you're paying for it. You can't treat the property as your own property.
And Peter, that's all really helpful. And then thinking about who the money is going to, a big benefit of these trusts, right, is that you have some control over when and how the money goes to the beneficiaries, right?
Yeah, so the trust can be structured so typically you wouldn't be the trustee, you'd have someone else's trustee, but you can name someone you trust, your brother, whoever, to act as trustee. And so you can rely on them to make appropriate decisions about distributions, not making huge distributions to your kids when they're 18, but also you can include terms in the trust to prevent distributions that you wouldn't have agreed with if they'd happened on your watch. So there's a few things there. And sort of the bigger picture idea is that with a non-grantor trust, you're actually getting assets out of your estate. So it's a huge estate tax savings as well. This chart only shows the income tax savings, but there's a huge estate tax savings here. So in this example, the $67 million, around 41 million have been transferred to the non-grantor trust. So that's 41 million that's not going to be subject to estate tax when you die. It would otherwise, in this example, there'd be about $20 million of estate tax on that $41 million of stock inside of or investments inside of those three non-grantor trusts. And here she's avoiding not only that income tax, but also all of that estate tax as well.
That's right. Sorry, Peter, I jumped the gun with that slide. So just wanted to get here before people start dropping off. We're just about at time. Hope this has been helpful. The bottom line is there are a number of vehicles that you can use for this specific purpose. You've got access to us, to our expert team. You should use it. You can always schedule a call directly on our site or at this link, valor.com/schedule. You can email me or Peter directly. You can also email support@valor.com. And our model really in general is we really want to talk to you, whether you're a person who's selling shares or an advisor or CPA with a client who's doing so. We think a 30-minute call is going to move the ball forward pretty significantly. And that's really where we add a ton of value and can help people decide if this is worth pursuing. So strongly encourage you to schedule something if this is relevant to you. We also just very briefly help with all manner of tax situations, not just QSBS, as many of I can see a bunch of repeat names here, but we help with ordinary income tax planning, with other capital gains that are not QSBS eligible. And as Peter was alluding to right there, estate tax as well. So if you or your clients earn more than, let's say, $300,000 a year, if you have a capital gain that's going to be $500,000 or more when you sell, if you've got an estate that's worth more than, let's say, $5-ish million right now, or you expect it to be worth more than 10 million in your lifetime, it's worth getting in touch, and we can start talking about the potential ways that you can significantly reduce your taxes.